So this information is going to be very applicable nationwide to all of us. How many of you guys were around during the last market crash, if you will, during the Great Recession, 2008, 2009? Just type in the chat box. Me, I was, whatever. Okay. So many of you guys probably know that back in the day, for those of us that were on the front lines, and if you were in real estate, you were on the front lines. Hey, Jose, good to see you. Jose is one of our CDREs from Ventura. So those of us that were on the front lines back in the market crash, it was the Wild West in real estate and in lending. And we saw all kinds of stuff coming down in the news media that was not exactly playing out in reality. So we saw how a lot of times the, these things about extending foreclosures and doing loan modifications, and the government tried to come in with mandates about what they can and can't do. And believe it or not, the government doesn't have the authority over a lot of things. And so what happened was there was this entire misguided public, and people were out hiring lawyers, and they were hiring, these rogue people to do loan mods for them, and they were losing their houses after they had just signed agreements, and it was craziness. So what really inspires our talk today is actually a post that Jason Gordon posted. He posted something about forbearance is not forgiveness. And that sparked, it kind of went viral. So if any of you want to go to, when we're done with this, go to Jason's Facebook page, it's Divorce Loan Pro, right? Divorce Loan Pro. If you go to Jason's Facebook page, you're going to see the post. It's a brilliant post, and repost it to people, because this is really what people really need to know, and it's from those of us that are on the front lines. So I'm really excited that Jason has agreed to come on and share his knowledge. Be sure, realtors, this is the time when careers are made. This is the time when the cream of the crop rises to the top in our industry. So make sure that you take notes. Make sure that you have got really, you get a really good understanding of what Jason's going to talk about today, because this is your content for your newsletter. This is the content that should be going out. As soon as we're done, you should start drafting an email to your database, because I guarantee you there are people in your database, very highly educated people, that are confused and that are going to get burned if they don't hear the truth from us. So without further ado, I do want to give Jason the introduction that he deserves. So Jason Gordon, he has been in the mortgage industry for well over 20 years. He holds a master's in business. He holds an MBA. He is frequently an in-person keynote speaker for family law organizations as well as real estate organizations, gives continuing education to lawyers, gives continuing education to realtors. And Jason has been around through thick and thin. So he is really an expert that we can all learn from. And so I am going to, in fact, I asked Jason if I could share with you guys something that really kind of captures what he does and what we can all strive to become. So hopefully you guys can all see my screen, and here we go.
Nearly every divorcing homeowner has at least 4 different puzzle pieces that must be connected before their divorce is finalized. Puzzle piece number 1 is divorce law. Among other things, this process involves the courts, contracts, a judge. Puzzle piece number 2 is IRS tax law. There may be significant tax implications for doing such events as selling real estate, receiving alimony. The fact that I refer to this population as divorcing homeowners implies that real estate is involved, which is puzzle piece number 3, And of course, where there's real estate, there's typically mortgage financing questions, which is puzzle piece number 4. Here is where the problem exists. If you look closely at this image, these puzzle pieces are not yet connected. That is symbolic. The reason they are not yet connected is because the 4 professionals involved, family law attorney, CPA, real estate agent, and loan officer, typically work on their own piece without collaborating with each other throughout the process. This communication deficiency shifts the burden of connecting those pieces directly to the divorcing homeowner, who is typically not an expert on any one of those pieces, much less all 4. And oh, by the way, this person's going through an emotionally traumatic process and might not always be thinking clearly. The bottom line, as professionals, we can do better, and we should do better.
I love it. I love that. And absolutely, that is our core belief, and that is what we absolutely share in common, that we as professionals need to step up in someone's time of crisis. So that's what we're here to do. And I am going to go ahead and turn it all over to you, Jason, and just kind of step out of the way and let you do your thing.
Sounds great. Well, thanks, Laurel. I'm going to share my screen right now just to make sure that is okay. So give me one moment here. Can everyone see my screen?
I can.
Okay.
Can everybody else see Jason's screen? Perfect. Thanks.
All right. Well, first of all, I want to thank all of you in advance, sincerely, for your time and attention today. I know we're all very busy, and I do appreciate your time. And I hope you will find use and value in this content. Before I start, I do want to just take a moment to spotlight and thank a couple people here. As Laurel said, I'm the only person who has gone through the RCSD, CDLP, and CDRE training. And I can just say, with complete respect to all parties involved, in my humble opinion, if you are a mortgage professional, you are best suited to get your education through the Divorce Lending Association, the CDLP training. Jody Bruns, fantastic. It's ongoing. It's very full of a lot of street smarts knowledge, and I'm constantly learning from Jody, from her team, from the community. It's fantastic. And of course, I know many of you are real estate agents. It's my humble opinion, if you're a real estate agent, you are really best suited at the Ilumni Institute. Laurel Starks, I mean, talk about someone who walks the walk. You can look up her numbers. You can listen to her. She literally day in and day out is dealing with divorcing homeowners, family law attorneys, and just being a great leader. Her faculty is full of attorneys. We have 3 very strong attorneys on her faculty. A mortgage underwriter, a Superior Court judge even teaches some of her master class. Just a phenomenal experience. So I just wanted to take a moment to endorse those folks, and it really is an honor for me to even be, on the same billing as them, because I just feel like they are just top notch. So that said, just want to thank you for all that. And I do want to just, before I begin, let's acknowledge that there are different things going on in different parts of the country. Different lenders have different policies. I'm going to give you a general idea of what's going on, with the full disclaimer that I'm not going to go in too deep into the topic. So if I leave things out, it doesn't mean I don't know about them or I'm leaving them out on purpose. It just, we want to, have a good flow of communication in this presentation. And if I say certain things about certain lenders or just what lenders are doing, let's all agree that certain lenders may have different policies at different times. I'm just giving you some general examples. So with that being said, as you can see, the title of this presentation, we have a ripple effect going on here. And at the heart of it, of course, is COVID-19. At the heart of it is forbearance. But this is rippling into the real estate and mortgage industries. And of course, all of us are part of a divorce lending and real estate page here. This does ripple into the divorcing homeowners as well. So let's just keep that in mind, because there is a connection on everything that goes on here. To keep my attorneys happy, let me begin with putting all my license information on there. My compliance team watches everything I put online, so all my license information is on there. Nothing I'm saying today is an offer to lend. There are no rate quotes. There will be no legal or tax advice. And I think we all know why I have to say these fun things. So let's get started. First thing, I want to identify the players involved, okay? We toss around words like lender and bank and investor. let's go ahead and just assign kind of a value to each name here so we know kind of what we're talking about here. So of course, we all know what a borrower is. Someone who has borrowed money, in this case for a mortgage loan. They got that money from a lender. A mortgage lender is the company that helped that borrower originate that loan. Okay, when I say investor or bank, that's kind of the behind the scenes company that buys this loan from the lender. And ultimately, someone has to service that loan, which I'll discuss in a moment. We call that entity a servicer. So basic lending 101, just a couple of basic concepts here. So lenders obviously lend money to borrowers. They have these non-delegated correspondent warehouse lines of credit that they use to lend that money. Think of a credit card on steroids. Your credit card might have a limit of $10,000. Imagine one for $100 million or $500 million. These are big lines of credit that lenders use to lend money to the borrowers. When they lend the money, it's like making a charge on your credit card. So if your balance was $100 million, your limit was $100 million, and you lend $400,000 to somebody, you have $400,000 less in your available line of credit. We kind of get the concept on that. So the lender has a guarantee from the investor or bank that they will ultimately buy that loan, allow the lender to repay that credit card, and reuse that money to lend to new borrowers. We call that churning, C-H-U-R-N-I-N-G. Churning is a good thing in this case because it allows the lenders to keep lending to different borrowers on an ongoing basis. And as real estate professionals, many of you on this call here, you know the value of us lenders having money to lend to these borrowers. That keeps the whole process going. Now, at some point, when the loan is purchased, we're going to have a need to have that loan serviced. Okay, let's talk about what the servicer actually does. So the servicer is kind of a clerical entity. So they're going to send the monthly bills to the borrower each month and make sure the borrower has their statements, all the details of the loan balance, the payment due, the interest rate. If the borrower has an impound account, also known as an escrow account, to manage their property taxes and homeowners insurance, the servicer is going to manage that as well. So they'll make sure the property tax installments get paid usually twice a year and that the insurance gets renewed once a year. And if there's ever a situation where the borrower does not continue to pay as agreed, now the servicer has to kind of look at that option of what they call loss mitigation. So loss mitigation was a real buzzword back in the previous crisis. And I'm going to call this crisis 2008, even though we know it lasted more than 1 year. But we'll just call it the crisis of 2008. That way I'm not saying 8, 9, 10. So 2008 is our previous crisis. That's when loss mitigation really became kind of a buzzword for most of us in the business. So loss mitigation is really the process where the servicer is going to have to work with the borrower. If the borrower becomes delinquent, or what we call in danger of imminent default. Okay, imminent default, an example of that, let's just say you make $5,000 a month, but your debts are $6,000 a month. You're a negative $1,000 a month cash flow. And you have $4,000 left in your savings account. Each month you take that $1,000 from your savings account to pay and just kind of keep yourself current. But you only have a few more months left before there's no more money to pull from. We call that imminent default. Well, it's a default is going to happen. Let's go ahead and be proactive ahead of time to cut that off before it gets ugly. Okay. And so loss mitigation from the servicer's perspective, it's kind of a lose-lose, right? It's kind of like if I said to you, pick one, either I smack you in the face or I kick you in the shin. Neither one sounds all that great, but you have to decide which one's going to hurt a little bit less. That's what loss mitigation is in the eyes of the servicer. So there are 4 real common ways that servicers might work with a borrower. And I could spend an hour on each of these. I'm not going to go into all the details right now, but remember back in 2008, loan modifications were a thing that allowed the payments to be modified into a more affordable set of terms. Short sale, we all know what short sales are. You owe more than your property is worth. The servicer allows you to sell that house at market value short of the payoff. A deed in lieu of foreclosure, for lack of a better term, it's a mutual surrender. Here's the deed, here are the keys, all right, didn't work out, good luck to you. And of course, forbearance is at the heart of today's presentation. So we'll talk a little bit more about forbearance. So the most basic way to describe forbearance, as you see on the screen here, it's a temporary postponement of the mortgage payments that the servicer is giving to the borrower instead of going into foreclosure. So they're kind of working with the borrower, but it's implied that it's a short-term solution, okay? So here's where a good bit of terminology needs to be identified, because we all have all these different ideas of what forbearance is. And I'll go into that in a moment as to why we have different definitions of forbearance. But first, I want to just make sure you know the difference between deferment and forbearance, because deferment is what a lot of us think of when we think of forbearance. And let's face it, deferment is the ideal form of forbearance. Deferment means you take the money that you didn't pay each month, and you just, let's say it's $10,000 that you didn't pay over a period of time. That $10,000 doesn't go away, right? Forbearance is not forgiveness. That $10,000 doesn't just evaporate. It gets paid back at some point in time. In a deferment, they add it to the back of the loan, typically, okay? And so at that, when they add to the back of the loan, it's implied that at some point that will get paid, usually in one of three ways. Number one, when the property gets sold. As we know, the entire lien is paid off at that time anyway when the property is sold. Number two is when you refinance the loan. The new loan pays off the old loan in full, including the forbeared amount. Or when you get to that lovely moment in life where you write that final big check to the bank, there you go, or the servicer, there you go, and that point, it's paid off at that time. There are different variations of forbearances. You hear second mortgages, you hear other different plans, but for the most part, we'll focus on deferment versus what we call forbearance, which is when you can sort of not pay for a little while, but then when that period ends, it's time to pay the piper. And let's give an example of that. And for those of you that did see that Facebook post, these are the same numbers. And by the way, if you want to see that post, as Laurel said, go to Divorce Loan Pro Jason Gordon Mortgage. You'll see my smiley face. That's my business page on Facebook. I do archive all those posts on there, and that one you're welcome to to share at your leisure. But in this example, you have the borrowers that owe $2,500 a month to the servicer. Borrower, maybe because of COVID-19, is having some problems. They decide to call their servicer because the media is saying that they can do it. And they call their servicer, and the servicer says, sure, we'll grant you a 6-month forbearance. Okay, 6 months of not having to pay your $2,500. And this is inclusive of taxes, insurance. This is PITI, principal, interest, taxes, insurance. Well, in month number 7, it's time to pay the piper. So now we have what I call a very uncomfortable conversation. It doesn't need to be uncomfortable if somebody knew in advance and asked the right questions in advance, but most people right now are not. And as Laurel said, they're listening to their friend, their neighbor, their coworker who once did a forbearance or knows somebody who did a forbearance, and suddenly they're the experts. Not a good idea. We're the experts. We're in the field. We're in the trenches. It's up to us to proactively message our clients, our databases, make sure that they understand what should be going on. So with that in mind, on month number 7, the servicer says to the borrower, you owe us $17,500. How many of you want to get that phone call? Not very pleasant. Borrower says, but why? Well, you took $2,500, you didn't pay it for 6 months, that's $15,000. Plus you owe the new payment of $2,500, that's $17,500. Well, it's very common at that point for the homeowner, the borrower, to say, well, I can't do that. What can we do? Any other options? Well, sure. You can take that $15,000, pay that over a 12-month payment plan. That sounds good until you do the math. $15,000 divided by 12 months is $1,250. So you take that $1,250, tack it on to the $2,500, and now suddenly you owe $3,750 for the next 12 months. Okay, that could be very uncomfortable. Now, in my world, as a mortgage originator, we look at math. We look at a lot of calculations. And so a big part of qualifying is what we call a debt to income ratio. So imagine a fraction. The top of the fraction are the debts, The bottom is the income, and we're using gross income. Divide the two and you get what's called a DTI, or debt to income ratio. Okay. Now, all these examples, very important to know, all these examples assume, very careless assumption here, that there's no other debts on the credit report. No credit card payments, no car loans, no student loans, no personal loans, which is already a very tough assumption because we know many people have those debts. But for this example, there's no consumer-related debts associated. We're just looking at the PITI housing payment divided by the gross income, gross before withholding taxes are pulled out, before their medical insurance is paid, the gross money. So let's just say when they qualified for the loan, they qualified for that $2,500 a month payment, they were making $6,000 a month. You divide those two together, we have a 42% DTI. That is well within guidelines for all the programs on the market right now. Okay, but if we now look at that repayment plan, take that new payment of $3,750 divided by that existing $6,000 a month payment, income, we're now at 63% debt to income ratio. I can tell you that nobody would get a new loan with those terms. Okay, so now we're putting this homeowner, this borrower, in a tough situation. Now let's think about what's going on around us. We had over 6.6 million filings of unemployment last week. COVID-19 is keeping us at home, keeping us away from our peers, our clients. Many people, many industries are losing their jobs, going on temporary or furloughs, or getting laid off. Their business is kind of falling apart. Let's just say, for example, that these borrowers can go back to work, but they're going to have a little bit of less income. Maybe about an 18 to 20% decrease in income. Now they go from $6,000 a month to $5,000 a month. Well, if their payment stayed at $2,500 a month, divided by their $5,000 new income, they're at 50% debt to income ratio. That's not ideal, but it's kind of doable. Maybe they make a couple adjustments, but they can find a way to make their payments. But if they have an increase in their expense combined with a decrease in income, now they owe $3,750 against that $5,000. That's 75% debt to income ratio. That's before withholding taxes, medical insurance, car insurance, food. Think about just how they're going to live. This is an example of what I would call imminent default, and it could have been potentially avoided. So you hear about different types of forbearance agreements. Why would lender A have a different policy than lender B? Well, first of all, our industry is kind of across the board anyway, on different guidelines, different repayment plans. But when you look at the servicers, about 40% of them are non-bank entities. Okay, a bank entity collects depository money. Okay, so we know what banks are. We know where our checking accounts are held. These are depository institutions that have a lot more money on hand versus a lot of these other companies out there. You've heard of Mr. Cooper and PennyMac and some other ones that don't have depository money. They're what are called, obviously, non-depository servicers. They are right now in a lot of trouble. In fact, I want to give you an idea of the trouble that they're in. Think about any movie that you've ever seen where the walls start caving in, right? We're in a room with 4 different walls. If one wall comes, is caving in towards us, we can kind of back up away from that incoming wall. But if there's walls on each side going at the same time, that gap gets obviously shortened very quickly here. And that's what's happening to the non-bank servicers. So let's look at a couple of things that most people don't know about. Okay, when that servicer buys that loan from the bank investor, remember our previous slide, they buy the servicing rights for about 1% of the loan amount. Okay, maybe a $400,000 loan, they pay $4,000 to buy the rights to service that loan. Their break-even period is just over 3 years. They make about 30 basis points a year, so just over a 3-year period, they make their money back, which, if you think about it, these are 30-year loans usually. That's a good business plan if people are keeping their loans long term. But what do we know about people refinancing over and over again the last few years? It's been kind of an epidemic, right? And people like me, mortgage originators, we're happy to do it because it puts our clients in a better situation. And last I checked, I have a fiduciary responsibility to look after the highest and best for my clients. And if I can drop their rate down and the math makes sense, I'm going to do it. But this hurts the servicers. I don't mean to do it. It's an unintended consequence, but it sure is happening. So that's one issue. And of course, with the rates dropping like they did recently, everybody seems to be refinancing right now, which is great for me and for all these borrowers, not for the servicers. But here is the knockout punch, okay? The other side of that is a risk of default of future payments, okay? So what a lot of people don't know about with servicers is whether the borrower pays the servicer or not on any given month, the servicer still has to pay the bank/investor. I'm going to repeat that. Whether the borrower pays that $2,500 to the servicer, in that our previous example, whether or not that gets paid in the month of April, servicer still has to pay that money to the lender. To the bank investor. So imagine fronting the money for your client. Well, if it's just one client, no big deal. These servicers have some money. But here's where the problem gets really uncomfortable. Back in 2008, when you wanted any kind of a loss mitigation remedy, loan modification, short sale, deed in lieu, or forbearance, you had to prove hardship. You had to submit a financial hardship package where you documented a decrease in income and or an increase in expense, typically brought on by a loss of a job, a medical event, or some other catastrophe that you didn't see coming. The problem right now is that there's no barrier to entry to get a forbearance. Well, let me correct that. The barrier to entry is that you must call your servicer and attest that you have been negatively impacted by COVID-19. Who hasn't? Is that really a barrier to entry? No financials have to be shown, no documentation for a loss of a job, a medical event. You just call your servicer and say, hey, I heard I can get it, I want it, do it. And they have to do it. Imagine fronting 2, 3, 4, 5 million borrowers, not dollars, but borrowers worth of payments every month. The servicers don't have that kind of money. Okay, and at some point in time, they're in danger of imminent default. So let's talk about what's going to happen now, because it's so common. As Laurel said, we want to constantly apply our past history to the present dynamics. But we have to be careful with that, okay? Because if you think about it, the playing field is different in 2020 than it was in 2008. Let's say in both years, let me give you a better image there. Sorry about that. In both years, we have borrowers that owe $400,000. Okay. In 2008, we had a huge reduction of property value. Probably, for the most part, us mortgage lenders caused that problem. With some of our very loosey-goosey guidelines, you can fog a mirror, you can get a loan. We had negative amortization. We had 2-year fixed with these, exploding margins after the fact. We were the cause of a lot of that problem back in 2008. Okay, and it's a shared blame, but lenders were definitely at the heart of that. So we caused these values to go down. So imagine from a leverage perspective, imagine you're the servicer and that borrower is not paying you back in 2008. It's kind of a game of chicken, right? The servicer is threatening foreclosure. The borrower is saying, oh yeah, well, I dare you to come get it because I'm upside down, I'm underwater. My house is worth $350, I owe $400, I dare you to come get it, okay? It's hard to play a game of chicken against somebody with nothing to lose. And so that caused the servicers to have no leverage. And they had to kind of look at the options and say, well, if we foreclose, how's that going to look? We have to wait a certain amount of months of not getting payments. We're backed up. We only have so much staff to get these things done. We have these huge amount of legal fees. And at some point, we finally get the home, open that front door, and what are we going to see when we open that door? Are people taking a hammer to the drywalls, pouring concrete down the toilets, pulling out copper wiring? Who knows, right? But these are all things that could be happening, and that's just obviously not ideal on any level. Okay, so in '08, we had a real issue with a lack of leverage for the servicers. Now look at 2020, present day. We have equity. Before COVID-19, our economy was thriving. Okay, so now that borrower owes $400,000, but their property value is, let's say, $540. Now the servicer says, well, hey, now after our forbeared time frame, after we've given you this option of this new monthly payment, if you don't start paying us, we're going to obviously take our first opportunity that we can to file a notice of default. And we're going to get your attention really quickly because we're going to threaten foreclosure, and we have the right to do it. You signed a promissory note. We have a deed against your home. We have leverage against you right now. And do you want to walk away from $140,000 worth of equity? Because either way, you're going to be homeless if you don't pay us. Why not just sell your house, cash in your chips, pay us off in full, and you go do what you do somewhere else? That's the mentality the servicers are going to have right now. And honestly, given the situation that they're in right now, do you blame them? Again, this is not a personal thing, but just from pieces on a chessboard here, the servicers really have no choice. If they're facing the potential of going out of business, and they're going to kick the can for a little while here and just delay the inevitable here of all these deferred payments, they're going to get their money back one way or another. So let's talk about what some of this stuff is doing now to the modern day lending environment, because this affects all of us as far as modern day guidelines. So there's a term in our industry called a overlay. Okay, an overlay, as you see on the screen here, is a qualification requirement applied by the lender that exceeds the standard qualification parameters of that loan program. Okay, so when we lenders apply an overlay, we're making the process to get approved a little bit more difficult. Metaphorically, when you're a borrower and you want to get a loan, you have to fit inside of a box. An overlay just makes that box smaller and harder to fit inside of. So less people are going to be able to fit inside that box. So examples of overlays in our industry, the most common are raising minimum credit scores, reducing the maximum debt to income ratios, reducing the loan to value. In other words, if you're buying a home, maybe you have to put in more money now, more skin in the game to buy your home. If you're refinancing, maybe rather than going to 90% of your home's value, we cap you at 80. These are examples of LTV overlays. And of course, we have some programs that have asset requirements. Okay, we call that post-closing liquidity, where if you're buying a home, when all the smoke clears, how much money do you have left in your savings account? Can you weather the storm if you lost your job by pulling some money out of your savings account for a period of time to make your payments current? So how does that look for current mortgage programs with all these guideline changes? And you see my asterisk up on top and at the bottom here. These are going to vary from lender to lender. So, if you want to put it in your chat, well, I know a lender that does this, you're welcome to. Just know that I get it. These are general ideas of what the market's doing. I work for a direct lender and a broker. We do shop the market. This is a sampling of what we're seeing right now as a whole. Okay, so FHA and VA loans, the Ginnie Mae loans, are taking a little bit of a hit right now. Now that's probably going to correct itself soon, but right now they are taking a bit of a hit. So technically you can do an FHA loan with a 500 score, but no one ever wants to do that. So the typical overlay has always been 580 for some, maybe 600 for others, or 620 for others. But right now, a 640 is kind of just the new barrier to entry for most FHA loans, but those rates are kind of high. And who gets FHA loans usually? Usually people with low down payments. So when you start adding points to their interest rate, that hurts their ability to get that loan. Okay, so 660 is kind of the new sweet spot right now. Again, that might change soon, but right now, that's a pretty big change. From 580 to 660, that's a pretty big overlay, and it's affecting a lot of people right now. Now VA, which in my opinion is the best loan on the market for the most deserving population out there, has always been a 620 is kind of that minimum barrier to entry. Now we're seeing 640 is kind of the minimum, but even that's requiring, again, more acquisition costs, higher rates. 660 on that one as well is kind of the new ideal minimum standard to get a VA loan currently. Now, non-conforming, what we call jumbo loans, are very big where I am in San Diego. We have a lot of jumbo loans. I have a lot of jumbo clients. What we call non-conforming. These are outside of Fannie Mae and Freddie Mac. The non-conforming or jumbo loans, those are really raised the bar here. I mean, 700 is kind of available, but it's not pretty. 720 is kind of just getting over there, but 720, 740, 760, that's kind of the new norm right now. And that's hard because if somebody is waiting on applying for a loan and driving up their credit card balances, well, 30% of your weighted score has to do with the balances on your credit cards divided by your credit limits. So if you can have a perfect history, money in the bank, but if your credit cards start going up because you're waiting to apply for your loan, that could bring your score down below 700. We see a lot of people with perfect credit payment history with scores below 700. So again, it's affecting people right now. Now, I got a duplicate slide there. Sorry about that. And we are seeing, by the way, rates for the jumbo right now are kind of in those mid 4s and up on most cases without paying points. Where I'm quoting conforming loans and on purchase loans, 3 1/4, 3 1/8. So a pretty big variance right now in terms of conforming versus jumbo, even if you had a really high credit score. Now, we sometimes have some casualties of war here, and right now the casualties in the program that are out there, the non-QM are kind of gone. So QM stands for qualified mortgage. That's kind of the way that the government came in and told the lenders you have a certain standard of which you have to verify a borrower's ability to repay when you originate your loan if you want a clear path to be able to foreclose on them later on. So the Fannie Mae, the Freddie Mac, the FHA, the VA, they all fall on these QM guidelines. The non-QM are kind of like the subprime lenders out there. Okay, the ones that are doing the things that you wouldn't normally do. Like, for example, a self-employed borrower using 12 or 24 months bank statements in lieu of tax returns to qualify. Reduced seasoning periods for major credit events like a bankruptcy or foreclosure. What we call stated income, which is kind of like a bad word now in our industry. These are all gone right now, and probably gone for, I wouldn't say for good, but for the foreseeable future, because Wall Street has no appetite on the secondary market amidst a pandemic with 6 million plus filing for unemployment. They're not going to be this loosey-goosey on their guidelines on these loans. They dried up overnight. I'm hearing whispers that certain ones are trying to stay in the game, but nobody is really making any loans right now that I'm seeing on the non-QM. The down payment assistance, these bond programs, again, these are allowing people to buy a home with no skin in the game. 100% financing, that's not what Wall Street wants to see right now. Knowing that they might have an issue with their jobs. There's no leverage the servicer will have if you go into this with zero down. Only exception right now is VA. So because we're kind of a divorcing community here, let's talk about what this might be looking like for the clients that we serve in the divorce community. Okay. As many of you know, we have what's called the Rule of 636. Without going into all the guidelines, this has to do with alimony or child support. Let's focus on child support for a moment. Let's say he is going to pay her $3,000 a month in child support. The Rule of 636 says that we need at least 6 months of him paying the contracted amount that shows on the settlement agreement, 6 months or more of him paying that debt on time in full each month. And then 36 months of what we call continuance into the future. So if he's paying her until the daughter turns 18 and she's already 16 years old, we lack 36 months of continuance into the future. That's just the most basic interpretation of that guideline. There's more to it I won't go into right now. But what happens if somebody's losing their job? or reducing their income and only has the ability to do one of two things, pay their mortgage or pay their ex-spouse. This could affect the ex-spouse's ability to use that $3,000 as income on her application if he doesn't pay her. Okay, now that can really have a ripple effect on pre-approved equity buyouts. Okay, what if I got somebody pre-approved with Mr. or Madam Attorney back in January and we verified 636 was being met perfectly? So we had 6 months plus in previous on-time history each month and well over 36 months into the future, but now this month they choose to not pay. We have to start all over again for a new 6 months of fresh payment history. That can really affect an equity buyout. So kind of keep that in mind. And then really these equity buyouts have other ways that they're in jeopardy as well. So again, these overlays. Okay, maybe I got somebody approved with a 620 score that now needs a 660 score. Okay, remember COVID-19 is only a few weeks old here, maybe 4 or 5 weeks. Back in January, February, this wasn't a thing, much less last year. So we may have to look at these borrowers all over again from a fresh lens to see if they can still qualify. The IRS has put back the tax filings for 2019. Push it back 3 months. Well, what if somebody's self-employed? How is the lender going to look at that self-employed borrower and know their income? Because we cross-reference things. Everything about the lending origination side is a system of checks and balances. We cross-reference. We don't take the word of the borrower, the loan officer, the realtor for what they say verbally, because we're all interested parties. We have an interest in the outcome of that transaction. So we verify things through third party. We contact the human resources to make sure that they're still working. We cross-reference the tax returns provided to the lender by the borrower with what the borrower filed with the IRS. Checks and balances. And so that might push back some ability to verify things as well. Of course, as realtors, most of you on this call, you know that if the in-spouse is not cooperating with showing the home, that could affect the saleability of the home, which could be a thing in any market, but it could be a bigger thing in this current market because that in-spouse might say, look, I have a bona fide reason to not let strangers in my house amidst a global pandemic. These people might be infected with COVID-19. I don't want to risk myself or my family by letting people in my house. And really, I mean, do you blame them? I don't want people in my house right now. Of course, reduced assets. Have you looked at your bank statements over the last couple of months? Have you seen what the market's done with our money? We lost a lot of money. That could affect someone's ability to still buy a home. You may have verified funds to close back in January. They may not have those same funds to close now here in April. That could affect their ability to buy the home as far as funds to close, and or if there's a post-closing liquidity or cash reserve requirement, they may no longer meet that requirement because of all this. How about employment status? We had 6.6 million unemployment filings within the last 2 weeks. Our borrowers may not still be working. They may be on temporary furlough. They may be laid off. They may be in a business that says, hey, we'll call you back when things open up, but we can't have you come in now. Lenders are going to check up to within 24 hours of hitting that funding button. They're going to check and make sure that borrower is still employed. So divorce or not, as realtors, if you know that your borrower / buyer or seller has lost their job, let the lender know. We're going to find out anyway at some point. Let's be a team. Let's be proactive in these situations. Okay, income. Okay, has their income dipped? A lot of people's income has dipped. The good news is you still have a job. Bad news is you're making less money. That could affect your ability to qualify for the loan because we're going to do a fresh debt to income ratio calculation on your current income, not what you once were in the past, not what you will be in the future. It's where you are now. And of course, credit. Whether you're running up credit card balances, as I mentioned before, that hurts 30% of your score. Whether you're not paying your debts on time, that's 35% of your score. It's going to hurt your ability to qualify. And please do me a favor, if you only hear one thing, hear this. Let's stop listening to the media and politicians when they say that forbearance will not affect your credit. Forbearance will affect your credit. Lenders will always know whether you paid your mortgage on time. Now, there's not specific guidelines in place at the present moment that are addressing forbearances, but every underwriter I spoke with has said with full agreement, it's coming. Okay, you stiffed us at a time like this, we're going to get you later on. They may have, 12 months of required payments on time before you're eligible, or some other variation of that. I think it's coming. And I think it's inevitable at this point in time. Let's not be surprised when it happens. Okay. It's a lot of talking. Just want to give you a couple of bits of information about me before I open up for Q&A. If you want to find me, you want to follow me, you want to stay in touch, there's this website called Facebook. It's kind of cool. You may have heard of it. I have a Facebook business page called Divorce Loan Pro. I am not a one-trick pony. I help plenty of people not in divorce. I've chosen this moniker because when I'm on those presentations that you saw earlier, it's a good way for people to remember me. And if they need me in the future to help a divorce client or an attorney and they forget my name, they can just punch in Divorce Loan Pro at the top, or even the word divorce, and I'll pop up if you already like and follow the page. So it's a good way to just kind of stay in touch. I do share some information. That video you saw earlier is a little bit grainy because of the Zoom call. There's a better version of it on that site, along with the forbearance article, as well as other things that I'm trying to post. I'm not going to tell you what I ate for breakfast. There's no pictures of my dinner. It's all content, and it's shareable content, and you're welcome to have access to it whenever you like. Real quickly, if you want to get hold of me directly, this is my phone number. That is my cell. You're welcome to call or text that number. Email is on there. Of course, gordonmortgage.com is my website. Again, just to keep our compliance people nice and happy, I'm going to put these next two slides on here. It does bear noting that, again, that I've done the CDLP, the CDRE, and the RCSD. I am all in on the education. I am kind of a groupie, as Laurel will tell you, on all the Ilumni Institute calls and trainings. And as Jody Bruns will tell you, I'm all in on the Divorce Lending Association as well. These are two phenomenal platforms. If you're not involved in them already, I recommend you do it. And again, my licensing information is here as well. And I'm out of breath. Laurel, you want to jump in?
Awesome. Thank you so much. This is I learned a lot just by watching this, and I think what's really good, Jason, is I think as realtors there's a certain amount of things that I think we feel like we should know about lending, and I feel like our clients think we ought to know, and yet there are some very rudimentary fundamentals that we just don't know. And so thank you for the education, even on those fundamentals and getting down to definitions. So very, very much, and the chat box is going, everybody is very thankful. You've got a real knack for being able to educate. So a couple real quick, and I want to get into some questions, but I do have one here. Where do you lend? What states do you lend in? Someone asked.
Okay, well, thank you for asking, first of all. I'm based in California, so my license works all throughout California without any issues whatsoever for me being the originator. The company I work for, I believe we're in 38 states now. I can always let you know, on a state-by-state specific basis. I have to look up some of these states. Admittedly, they're not all committed to memory, but in some cases, I may have to co-originate the loan with a licensed loan officer in that state, but I can still quarterback the loan pretty much start to finish. The borrower may have to have at least one conversation with a licensed loan officer to keep it legitimate, but I can definitely still be in touch with, a good portion of the states involved.
Okay, perfect. So very, very good. Good to know. I do have a question, and there are a lot in the comments. One question is so with all of these loan, bailouts and all of that kind of thing, do you foresee that lenders will include any income received as a result of like the SBA loans and the paycheck protection, all of that? Do you foresee that a lender will honor any of that as income?
No, unfortunately,
into like the unemployment kind of.
It's the same spirit as unemployment or temporary disability. It's not something that can be relied upon long term, so it will not be considered qualifiable income.
Okay.
Yeah, that's a hard no. That's not even a maybe. That's a definite no.
That's a definite no.
By the way, before you ask the other question, if you're forbearing your loan, your payments on property A so you can buy property B, first of all, that's going to kill you from a credit perspective, and we're not going to ignore your forbeared payments from your DTI ratio. I've heard that question asked, and I try not to laugh too hard, but don't do that. And please don't market your properties with no payments for the first 6 or 12 months. That's highly unethical, and please don't do that.
Right. Good to know. Yeah, I think that lenders have learned this time, especially from last time. A lot of things, there were, the short sell and, buy things. Okay, so here we go. We're going to go with a couple questions that I see in the chat box. What happens to impounds during this time? This is from Amanda Reichert. What happens to impounds during a forbearance period?
Great question, Amanda. So the servicer is responsible for still paying those payments to the investor bank. So remember, the servicer is covering when the borrower doesn't pay the servicer still has to cover the taxes and insurance as well. So the goal is to make sure that those stay current. But at some point in time, you have to pay the piper. So that money will be added to the amount owed. The servicers do not want to let the taxes or insurance go out of whack. You think about it, property taxes become an involuntary lien in front of them on title if you don't pay taxes back after a certain period of time. And the last thing they want to do is have homeowners insurance go out of force, have that property uninsured, have that homeowner let it match and run away, and have a pile of ashes as their collateral with no insurance policy to replace the dwelling.
So they're going to protect their own assets.
Cover their assets, for sure.
Cover their assets. Good. Okay, another question that we have from, so Vincent Grande, he indicated this situation was no fault of the borrowers. He has spoken with several banks who have said that they're not going to hold it against the borrower regarding the forbearance program. So what are your thoughts on that?
Well, let's define not hold against the borrower. Okay, first of all, they're gonna get paid. Okay, they're not going to, again, forbearance is not forgiveness. They're not just going to let that money go. So whether they charge interest or tack it on the back of the loan or put a second mortgage in place, that will vary. But now, as I mentioned right at the end of this presentation here, there's no current definitive guidelines that, well, let's back up. It's one thing to say that the creditor, the servicer, is not going to report a late payment to the credit bureaus. I still think that's going to happen, but let's just say it's not going to happen, but I think it will, but let's say it's not. That doesn't hurt the credit score. But a new lender looking at a new application can summons a verification of mortgage payment history, so you haven't paid for the last 3, 6, or whatever months, or some gap in between the last 12 months, and they can still hold that against you. You can have an 800 credit score and be ineligible. Okay, so remember, back in the 2008 crisis, we had a lot of really bad credit events. A bad credit event, an example of that is a bankruptcy, a foreclosure, a short sale. Different programs had different seasoning periods. A seasoning period in this context is like giving your child a timeout for, hey, you smacked your sister, go stand in the corner for 20 minutes. I don't care if you're sorry after 5 minutes, you're punished for 20 minutes. That's what a seasoning period is. And so different periods have been around for different events with different programs. FHA, VA, conventional have different seasoning periods for different events. There is highly likely to be a new seasoning period for forbearances. It's not announced yet, but I see it coming. And I just want you guys to be ready for it so we can help our clients.
So
yeah. Right now, by the way, I didn't say this before, but forbearance for some people is their only hope, and that's okay. That's why it's an option. But for people who have a couple $100,000 in the bank, who hear the news that they don't have to make their payment, they're hurting the system. Okay, think about the example I gave you before about the 2008 versus 2020. That person whose house is worth $540. What if they just decide to sell their home and cash out their equity? Not a bad idea, right? But what if all of them do that at the same time?
Market's
Real estate professional, what happens when we flood the market with inventory? It's a buyer's market. Property values decline. A lot of us own property. I own property. I don't want my property value to drop 30%. So this affects all of us.
Yeah, yeah, that's definitely good to know. And I think, Vincent, to your question and what Jason, was indicating, it's not just about whether the current borrower is going to hold it against them. It's future borrowers, if they want to refi, if they want to buy another property, how they're going to look at it. I don't think any current lender is in a position to dictate how a new lender is going to look at something. So definitely. Okay, what other questions do we have? So Valerie Upham, we know Valerie. She says, what happens if a servicer doesn't pay taxes and insurance as though they run out of money? And then another question, Amanda asks, what happens if the servicer files bankruptcy protection?
These are good questions. I don't know all the specifics on that. I'm going to read a bit of notes just for a second here, because I do know that there are different remedies currently in place right now for different situations. I'm afraid to open a Pandora's box right now, but I'm going to tell you about, so for example, Ginnie Mae, who services FHA, VA, and USDA loans. Remember I mentioned that they're highly impacted right now, but that they might be getting out of this a little bit sooner. I'm going to read this right now here. They have what's called a PTAP. It's a pass-through assistance program. If the servicer is unable to pay the investor, Ginnie Mae, through the PTAP, will give the money to the servicer. Well, not give it, but front the money to the servicer. The servicer who's taking money from Ginnie Mae can take that IOU and go over to HUD, the Department of Housing and Urban Development, and say, hey, I have an IOU from Ginnie, and HUD will go to the servicer and make them whole for the amount of the IOU. So this is the ultimate temporary Band-Aid that's in place to make sure that the whole system doesn't fall apart. But now keep that in mind, because now when the servicer goes back to the borrower and says, hey, start paying us that money back, and the borrower says, I can't, I won't, this is more motivation that I have to tell you that the servicer is not going to play around. They're going to go after that borrower.
Yeah, especially when there's equity in the properties. And for any of us who were on the front lines, we saw people who were in the middle of workout programs who got a knock on the door, and it was from an REO agent saying that they just were assigned the listing. I mean, horror stories that happen time and again and time and again. So all right. Well, listen, I don't want to take up any more of your time. You've been very, very generous. You all have been very, very generous. Jason is in our Facebook group. So if you're not part of the Divorce Real Estate and Lending Mastermind group, find it, go request to be part of it. If you're a lender or if you're a real estate professional, join our Facebook group, and Jason will be in there, and he can take your questions. He can answer them. And again, I thank you very much for giving us a very quality bit of information and education for our clients and for our own well knowledge. So thank you.
My pleasure. And I appreciate all of you who hung around and asked great questions and took great notes. And I'm thanking you all in advance for messaging this properly to your clients. We're all in this together. There's a great expression that keeps me going day in and day out. It's adversity doesn't build character, it reveals it. So in a time like this, we find out who we are. We have a chance to be the solution or the problem. Let's be the solution, folks. Our clients need us.
Amen to that. Amen to that. Thank you very, very much, Jason. I appreciate it.
My pleasure. Bye, folks.
We'll see you guys around. Bye-bye.